What is up, YouTube? This is the Working Investor. In this video, we're going to talk about risk management when it comes to these high yield dividend ETFs and risk management overall. Again, this is not financial advice, but I want to shed some insight. And risk management starts off with if you use margin or if you do not use margin. A lot of people like to use margin in these high yield dividend ETFs, and it could be a good thing or a bad thing. It's a double-edged sword. But when somebody uses margin, you have to be extra careful with your risk management. It's a double-edged sword. It could help you get your goals a lot quicker, but it can also take you on a detour much faster. So let's talk about total return. So total return is the dividends that somebody receives, maybe perhaps the annualized return of dividends, and then subtract the change in share price. Sometimes these shares high yield dividend ETFs sometimes sacrifice a little bit of a drop in share price, but the dividends sometimes way outpace that, right? So I've categorized it in three different sections. We have the dividends that pay smaller yield, but they actually tend to sometimes go up in price. So you actually have something that goes up in price, but you're sacrificing a smaller dividend. Bear in mind that when your dividend distribution is equal to or lesser than the risk-free rate of about 4.5% to 5% currently, October 2024, then you have to ask yourself, why are you investing in a market and putting yourself at risk, market risk, when you could be risk-free in the treasury products or high yield savings accounts or certificate of deposits or other types of cash positions. So you got to have at least, I would say, 5% or more, maybe 10, maybe double the risk-free rate in order to make it make sense. So some of these funds that come to mind is Calamos and Neos. Calamos, actually, I would consider more like a cash position in a way. So let's get into Neos. So Neos has, these products that are sub 15%. If you go to I think one of their highest paying ones is either IWMI or QQQI. So they have these products. Again, I'm not advertising these products, it's just some examples. If you look at IWMI, you could see that, they pay monthly and they give just under 15%. I think that's probably one of the highest ones that they pay. And they do tend to go up and down with the market, but they do tend to grow with the market. So, and also to bear in mind that if a fund goes up and down with the market, and the market tends to, and indexes tend to go up and to the right, there's positive drift overall, that's considered growth. And if it goes down, it doesn't mean it's not growing. It just means that relative to the market, it's just doing what the market does. Now we're going to get into the, then they have these, like, I call them mid-tiered yields. I mean, honestly, before these option-based ETFs, these were like incredible yields. Anything 8% or greater was considered a high yield dividend. But we are spoiled nowadays because we live in the new era of dividend option-based ETF funds that are paying massive, astronomical dividends that we've never seen before. And these are based on options. So now the 15 to 25%, I guess we'll call it the mid-tier, though I would say they're super high tier. And what comes to mind is the FEPI or the SPY-T or the GIAX. Like you could see, FEPI has this is from Rec Shares. And, they're giving around 25% distribution rates. SPY-T, GIX are around 20 to 24% dividend distribution rates. And these funds tend to remain flat and tend to preserve its value. The price will not be too drastic. Of course, when there is a crash in the market, there isn't anywhere you can really hide. Anywhere in diversification you can really hide. Everything will more or less go down. But these tend to maintain the price and pay out a consistent dividend, sometimes actually really consistent, very, very, very reliable so far historically. So then you got your funds that that don't tend to remain flat. They might go down, but there's a massive yield. And most of the time, the massive yield makes sense because it outpaces the drop in price. And these are your 25% to 110% dividend plus dividend distribution. And a lot of these funds, and then we'll talk about the unicorns. Then there are unicorn funds that have paid 25% plus in dividend distributions and have kept their price stable. And some even have increased in their price. Like, for example, MSTY, MicroStrategy's Misty from YieldMax, have just went from $19 to $30 and change. Now back down to $29 and change just in a couple weeks. And Misty opened up at roughly $20 per share. So we're talking some crazy situation where it's up 50% from the time the fund was incepted, and it pays out insane dividends. Again, past performance is not indicative of future gains, but you have these unicorn funds, and so those are awesome. But again, I'm not telling you to go into this and you got to do your own risk. But for example, IWMY, QQQI, these are your in the money puts by Defiance. You got your Ulti, your Misty, which I mentioned, Coney, Tesla. These are ones. Yeah, I can also add here all kinds of stuff like AMZ or AMD or Phoebe, all kinds of interesting stuff. So, that sound is probably the sound of money from a limit order that we have gone through. So yeah, like you could see here, let's say, for example, Ulti has payments coming up soon, and Ulti, based on the recent distribution, paid out 111%. These funds, even if let's say Ulti were to go down 20-30%, but it paid out, and if it consistently pays out about 110% return, that's still a win, because if you just use your math and do some arithmetic, you would see that the dividends far outpace the drop in price. So as long as that's the case, then mathematically it should be good. You also have to put into consideration the tax ramifications, because if you have a 50%, let's say, drop in price in an underlier, and you got 50% in dividend payments, even though it seems like you broke even, you really did not break even, because you have to pay about a lot of smart advice out there says you should at least keep a third of your money put away for taxes, more or less a good ballpark. But you have to speak to your tax advisor to get your personal situation to figure out what to do. But you want to make sure that the dividend far outpaces the drop in price, also outpaces enough to make sure tax, when you consider factor in taxes, that it makes sense. So then there are two ways of looking into a fund. Very important. So there's the ROI, return on investment, return on capital way of looking at a fund. And then there's the total return thought process. There's two camps out there. So the people with total return, as we went up to the top line over here, total return, like I said, is just the dividend that you received and subtract the change in share price. It actually sometimes could be a positive share price, which is awesome. And then there are the camp that look into return on investment. So if you got all your dividends back, if something paid 100% return, 70% return, then if you got 70% return, that means that in a year and a few months, theoretically, you would have all your money back that you put in your initial investment paid back to you in the form of dividends. Or 100% return, or 110%, you would have a year, or a little bit less than a year. And if you're compounding it, this thing will just exponentially be faster. And once you get your money back, then you're just playing with house money. It's almost like looking at it like a vehicle. If you buy a tractor to do jobs for you, to bring in income, it's an income factory. It's an income generator. And of course, the moment you buy your equipment, your tractor, it will go down in value over time. The more you use the tractor, it will go down in value over time, right? But if the tractor is bringing in revenue and profits, that's paying for the tractor 3, 4, 5 times over, multiple times over, that eventually let's say over a couple of decades, the tractor falls apart and now it's worthless, or you just sell it for parts for a couple $1,000 as scrap parts. You wouldn't be crying and say that my tractor went down in value. You'd be saying I made my money over multiple times over. So there's the ROI way of looking at things. And whenever we are talking more than a year, longer term, then we're starting to go into the ROI mindset. When you hold something that pays 50, 60, 70% plus over a year or two, and you've gotten your money back, now you've completely de-risked. You've gotten all your money back. There's a show called Shark Tank, and there's Mr. Wonderful, and he always mentions in the show, I'm not sure if you guys watch it, he always wants to know how fast he can get his money back. He wants to get royalty because he knows once he gets his money back, that's the speed of money. He can redeploy it somewhere else. He's de-risked himself. So that's a big thing. So now let's talk about hedging. Sorry about the back and forth. So when it comes to hedging, especially when you have margin, you don't want to get a margin call. So you want and also you want to know when you get your dividends, right? If you get a dividend, let's say of 110% return over a year, but your underlying dropped 50%, I wouldn't consider that you can use the 110% because you have to counter the fact that you lost about 50% of value. So whatever is remaining, in my mind, and I'm sure some people disagree, and I don't mind. If you disagree, let me know. I like to see different opinions. In my mind, the only usable dividends is the one that's in excess once you are made whole, right? So if somebody wants to avoid margin call, one may not be able to use the money and spend the dividends if the value went down in price. So what some people do is they buy growth stocks. So if your underlying sometimes is dropping a little bit, but it's paying back nice in dividends, but you want to use your dividends, in other words, you want to make sure your net liquidation of your entire portfolio stays the same or goes up. Some people just outright use the dividends and buy growth stocks. So the growth stocks is increasing the value of the portfolio, while the dividend paying stock may be reducing in value a little bit, though it's paying out good dividends, but then you could use the dividends or not get a margin call. And some people may go to the second point where they go for a lower yield, like we mentioned up here, the NEOS funds or Calamos funds. You sacrifice some of the dividend yield, but you go for these lower yield funds, but they still pay pretty decently. You saw almost 15% in that fund of the Russell 2000 in the NEOS. And they do get some growth. Over time, it tends to go up and to the right. Not as much growth, not as much dividend, but the total return, may seem a little bit attractive. So some people do those. Some people go into inverse funds, specifically inverse funds that pay. We're talking about funds that pay. Because when we're talking to the cash community, the income-based community, people who want to replace their income so they can live free, you want to make sure everything, we like to think about everything to pay us. So some people just buy inverse ETFs like that YieldMax has that provides income, though reducing volatility. The next thing we're going to talk about is diversification, because there's a lot of these single stock ETFs that if you put a lot of money to a single stock ETF, you have single stock risk. Of course, there are certain single stocks that are actually like a whole, pretty diversified. For example, Amazon, even though it's very diversified because it's in so many facets of retail. They have AWS, they have so many other things. They have international. Amazon is in many different countries. So there are certain large, like these massive companies out there, trillion-dollar companies, that you have to be very diversified and multinational in order to be a trillion-dollar company. So sometimes you could have single stocks that are pretty diversified, but in general, I'm sure most people would agree that having an index-based fund, it would be considered much more diversified. So diversification is a risk. So you're not exposed just to one stock or one sector. So you can have, let's say, for example, Roundhill Products. They have some, index funds that do cover calls like on the S&P 500, the NASDAQ, the Russell 2000. I'm not telling you to go into these funds. These are just funds that I like and I hold. So that's why I'm talking about it. But this is just my own personal journey. Another one I really like is GIAX, which I mentioned in my previous video the other day. And this is a fund that basically has been paying out around 24% recently based on the distributions, but their target is trying to get 15 to 20 or ideally 20, but they've been outperforming. In this one fund, you have exposure, and it's a call credit spread fund, and you have exposure to the S&P 500. You can see the third one. You also have exposure to the NASDAQ. You have exposure to the Russell 2000. You have exposure to the multiple Vanguard funds, international funds, from Argentina, emerging markets, India. So you have a lot of different exposure. Plus, they also have the flexibility of doing a couple plays on single stocks as well. Like they have a play on Taiwan Semiconductor and United Microelectronics. It's an incredible fund, in my opinion, but that's where I want to tell you my point, where diversification, sometimes even you could diversify even with these a little bit lower paying, but still pretty good paying, depending who you ask, high yield dividend ETFs, but it's much more diversified. And then there are also like uncorrelated assets you can do. Some people argue precious metals. Some people argue crypto, but crypto, I've noticed Bitcoin is very correlated to tech in a way. So, in my opinion, in what I've seen, my own observation, or some people go into real estate, so uncorrelated assets. Or if you have your own business, your own private business, you have control. There's a lot of internal factors that you have control over making your business succeed. So, something called the S&P 500. And there's a YouTuber out there, his name is Alex Harmozy, and he talks about the S&Me 500, that you invest in yourself, and you will definitely, investing in yourself, you can outpace many different, more than 10% return per year. So so uncorrelated assets. Then there are option plays, like, when you buy an asset, you're pretty much long the asset. Your whole point is to make money if the asset goes up. Or if you buy a high yield dividend ETF, you actually have you make money on the premium, on the income, and you make money if it goes up. But if you're worried about a black swan event or something, you have the potential to purchase a protective put. If you're worried about your underlying dropping, that kind of gives you it does cost a little bit of money, but it gives you like insurance. If you think about some crazy thing happening with the market in the short term, you could do that. One has the possibility of shorting the market just temporarily, if they choose to, or do a combination or all of the above to hedge. And I'm sure there are other ways and tactics people hedge. If you have there are some tactics that you use and about hedging that I have not mentioned. You could let me know in the comments. I'm interested and always curious to learn more. But yeah, this is my take on it. Hope you guys found some value. This is the Working Investor over and out. I hope you guys have a wonderful rest of your day.